So what we have today is IFRS 16 on leases. So it's possible for an entity to buy an asset without having to put down all of the money in such a way that you would be able to have an asset and you are given an opportunity to pay for those assets instrumentally. So we really want to look at how you account for transactions like that, where you can acquire an asset and you're allowed to pay for it instrumentally. And paying for it instrumentally in this case can span for so many years, and they make it so easy for you that you don't have to say you want to buy the asset. You can just have it for the period when you need it. You just be paying a particular sum, maybe every month or every year. Typically, most of us will know this scenario as rent in Nigeria. You know, that concept of renting, popularly homes or apartments, is you owning that apartment for that period you are using it, because the landlord cannot contest that apartment with you for that period you have paid for it. And some people can be in a rented apartment for so many years. In businesses, it's popular in the area of bus, like all these school that we have in Lagos. We have a lot of them. You would see that most of those drivers, somebody would have given them that bus. They are usually not the owner. And all they do is they will deliver certain amount of money to that person. And also, they are also making a living out of it. In most advanced economy, you will hear of mortgages. A lot of people key into this, where you'll be able to own a home. Then you are given the opportunity to pay instrumentally at your convenience, bit by bit. So today, whether it is rent, whether it is hire purchase, whether it is mortgages, whatever it is, we are going to be looking at how to account for transactions where you are using an asset that is not your own, and you're just paying for it instrumentally for many years. How do you account for such? That is what we want to look at tonight. And the name given to such transaction in IFRS is leases. So we don't have hire purchase here. Rent, we don't. We call everything lease. And that is governed by IFRS 16. So according to IFRS 16, a lease is a contract or part of a contract that conveys the right to use an asset, that is an underlying asset, for a period in exchange for consideration. So a lease is a contract or part of a contract. So when you have a lease, there has to be a contract, because without a contract, you cannot even have a lease. There has to be a contract. The contract must back it up before you can have a lease. It could simply be part of a contract. Part of a contract in the sense that the lease might just be a component of it, in that the contract deals with some other items, that lease is just part of it. Now, this contract conveys the right to use assets. This goes to show that there is a party that transfers his ownership, not necessarily his ownership, that transfers the usage to another party. Like the owner of an asset, he transfers the right to use that asset to another person. It won't be forever. Leases is assumed to be for a specified period, and it's not for free. It's usually for a consideration. So from this definition, we can conclude that there will be two parties involved in a lease arrangement, and these parties are the lessor and the lessee. The lessor is the owner of the assets. The lessor is the legal owner of the assets. And the lessor is the party that conveys or transfers the right to use an asset. It's the one that is giving up the use of an asset. It's transferring it to another person. Popularly, this lessor is called a landlord. Then there is the lessee, who is the tenant. The lessee now has the right to use the asset. This is the party that now has the right to use an asset. And these parties must exist for us to even have a lease, and it's usually for a period of time. This period of time, we usually call it lease term. Lease term. This is what I mean by lease term. Lease term. That's a period over which these lease arrangements go on. And it's usually in exchange for a consideration. So the lessee or the tenant is expected to pay throughout that period. The amount he pays, we call it lease rentals. He pays the lease rentals. So this definition exposes us to every element that is necessary to account for leases. Talking about there has to be a contract. Talking about there has to be two parties, the lessor and the lessee. Talking about the period over which the lease arrangement will go on. And talking about lease rental, which is the consideration or the rent paid by the lessee to the lessor. Yes, very straightforward and direct definition, but this definition is not detailed enough to take care of some dynamics that can occur, some events that can occur for us to be able to say that, or for us to say convincingly that a transaction is a lease. So for example now, let me just ask you this so that, let's say from this definition, let me give you a scenario. Let's say I have some money and I don't know what to do with it. So I decided to go and buy Marua. I'm sure everybody knows, everybody here knows what Marua is. So I bought 4 Maruas. I selected trustworthy, some trustworthy driver. I gave it to them. That okay, I'm giving you this Marua. Use it to work. And make sure you don't go beyond our area. Let's say Oshodi. Let's say we're in Oshodi, Lagos State. Don't go out beyond Oshodi, Lagos. Your activities. And every day you have to deliver. Every day you have to deliver 8,000 naira to me. They agreed. And I told them that when you do well after 2 years, the Keke Napep belongs to you. You can have it. So we shake hands. They started delivering 8,000 to me every day. Now, that's arrangement between me and those drivers. Is that a lease? I mean, this class has to be participative today, because majorly today I'll be teaching you the principles. Then most likely next week I'll solve questions. So I'll be asking for your opinions, like quite a number of times. Let me see the people that are in class. Yeah, Jamil, Latif, okay. Yeah, I think I can be talking to Latif because I know other people will not say anything. But yeah, Latif, let's go. What do you think?
I want to believe that it is a lease, sir.
Okay. Why do you think it's a lease?
That weekly or monthly payment will be considered to be a consideration receivable.
Okay,
And
good.
since there will be choice to own it later after several years or month or whatever. So that's my opinion, sir.
Okay, good. So it's not a lease.
Sir, it is not a lease.
Okay, why? Why do you think so?
The reason why I say it is not a lease from my own end is that when we are talking of lease, we are talking of something that conveys the right to use that particular, not to own it. You use something and you pay consideration in exchange, not that you want to own that particular thing, based on the definition you gave earlier. That is why I say it is not a lease.
Okay, good. Okay. So for now, I would say it's not a lease for now. Not because Jami's explanation was correct. Because that's not the reason why it is not a lease, but it is not a lease. I will come to that later. Another one. There's this company in Move. Move is a new company. Not new, they have been around for almost over 5 years now. So they partner with Uber. I don't know if any of you have actually called Uber recently or most of these e-ride platforms. You see that it's all these Suzuki small cars that used to show up now. That's Move. So those guys invested heavily in those. I mean, they are taking Uber business over from Corolla. Movies, those Suzuki very small cars are everywhere now. So, because what Move did was they invested heavily in those vehicles. So anybody interested in driving, anybody, just go to their office. I think you pay a registration fee of like 50K or 100K. I don't know. But there was the time somebody came to meet me that should come and be his, yeah, that should come and be his guarantor or something like that. So, but I said, the person said it has to be civil service or something like that. That's not the point. The point is that they usually agree with those drivers. They will give that, okay, we'll give you this bus. Go and operate with it. And every day, this is how much you deliver. And also, they are monitoring those drivers real time, everywhere they are going. And also, those ones also, they tell them that after some years, the car belongs to you. It belongs to you. Is that one also a lease? It is not a lease too. Now, you see, in those two scenarios or examples I've given you, the reason why they are not a lease is because those two scenarios, the driver, even though he has right to use the assets, there's something he lacks. There's something that driver lacks. And that driver needs to have that. Who is the lessee now? Before we can call an arrangement a lease. And in both scenarios, the driver lacks what we call right to control. Before we can have a lease arrangement, you see, in the first scenario, I told those people I gave Keke Napep to that make sure you don't take that Keke Napep outside my vicinity. So it means that the driver is just working for me. He doesn't have any control. The same thing for the move scenario I told you. They monitor them. They watch, they cannot go to move anywhere outside jurisdiction that is allowed. They cannot say they want to go out of Lagos or to do interstate. They lack control. And looking at this definition alone, it will help us identify or understand what leases truly are. And that is why this standard talks about identifying a lease. Beyond the definition, yes, the definition is there. That yes, we have right to a lesser conveyed right to use an asset. But it is not every act of conveyance of right to use that becomes a lease. Even though it's for a period, people are paying, it might still not be a lease. So for it to be a lease, for a contract to be a lease arrangement, the lessee must have right to control the identified asset. When he has right to control the identified assets, then we are talking about a lease. And when we say right to control, it means two things. When I say it means two things, I mean those two things must exist. They must be present for us to have right to control. And what are those two things? The first is right to obtain substantially all the economic benefit from the use of the identified asset. And two, right to direct the use of the identified asset. When we say right to obtain substantially all the economic benefit from the use of the identified asset, we are saying that the lessee must be the one that obtains substantially all the economic benefit from using the asset. And this basically means that it must be solely the lessee that uses the asset. No other person must be using that asset. It must solely be the lessee. Because before we can say convincingly that the lessee obtains substantially all the economic benefits, it means that it must be the only one that is using it. If any other person is using the asset, that means it doesn't obtain all the economic benefit. Not only that, it must also be in such a way that there is an identified asset. There is a specified asset that we can point to, that this is the asset that the lessee has rented. If we have a scenario whereby a lessor or somebody that has, let's say, buses that is ready to give it out to people, and somebody came to meet him that, I want to rent one of your bus. And the arrangement is such that the lessor or the owner of those buses tells that person that, yes, any day you need this bus, you can come and pick any one of them for the next 1 year. Every day, you can come and pick any one of them. You see, if that agreement should go on for 1 year, we cannot account for it as a lease because there is no identified asset. Because the agreement was that out of all the buses the owner has, that the lessee can come to pick any one of them. That cannot work because for it to be a lease, the lessee must substantially be the one enjoying economic benefit from an identified asset. And if you can pick any of assets, so that means there's no way we can judge that is obtaining all economic benefit from that asset. So for this A part to happen, two things. The lessee must be the only one using the asset, and we must be sure that there is an identified asset. I mean, that goes to show that the lessor cannot just come during the period of the lease that he wants to substitute the asset. It's not possible. He cannot substitute the asset. He cannot even replace it. Of course, if there is a damage, if there is need for repairs, if there is need for things like that, of course, they can be temporary replacement. They can be temporary replacement. But beyond those first situation, those situations beyond control, primarily, the lessor cannot substitute the asset for this A part to occur. And secondly, the right to direct the use of the asset, the lessee must have the ability to direct the use of that asset. And when I say direct the use, it means he must be the one making decision on what he wants to use the asset to do, how he wants to use the asset, how he wants to price the asset. He has to be the one making those decisions, not the lessor, the lessee. These two must exist before we can say we have a lease. And this is exactly what is lacking. This second one, right to direct the use in those two scenarios I gave you. In the scenario of Keke Napep that I gave you earlier, if I have given the driver the free hand to operate wherever they want to operate, I'm not restricting their use. It's a lease. Even if ownership can pass, that doesn't affect. That one is a much later event. Right now, the substance is a lease because the lessee would have right to control. The lessee will be obtaining, he will be the only one using it. So he's obtaining all economic benefits. The money I've asked him to deliver every day will simply be a lease rental. I will just be a lease rental. But this one's lacking. In those two scenarios I gave you, they lack right to direct the use of the assets. They have been restricted. Even in the move example, they have been restricted. They are not the one that determine the pricing. Is the software. They can't move outside a jurisdiction. They are restricted. And that is how you identify a lease in a contract. All these examples are similar to the scenario I've given you. I'll just look at one simple one and one complex one. Then I'll leave you the others to practice. So let's look at this very simple one, similar to the scenario I've given you earlier. But let's look at it. It says video transport company enters into a 3-year contract with CML, under which CML supplies video with 5 luxurious buses for the purposes of interstate transport. Okay. From this first sentence, first sentence, video is the lessee, while CML is the lessor. Do you all agree? video is the lessee, CML is the lessor. Because we're told that CML supplies video with 5 luxurious buses for the purpose of. So the owner of those buses is CML. Why video is the one that wants to rent it? They said CML owns the entire 5 buses specified in a contract. Okay, good. That means CML will happen to be the lessor. Said BDO determines the route taken for the interstate transport as well as the pricing. This one clearly shows that BDO, who is the lessee, directs the use of the assets. It directs the use of the asset. He said BDO can choose the use of the buses, can choose to use the buses for other purposes other than interstate. When the purposes are not being used, they are kept at the premises of BDO and cannot be retrieved by CML except BDO default on payment. If the buses need to be serviced or repaired, CML is obliged to provide a temporary replacement of the types of buses. Okay, you see that from this other paragraph, the fact that those buses are kept in the premises of BDO, CML cannot retrieve it unless there is need for repairs, something like that. He cannot come and say he wants to retrieve it. All this shows that BDO obtains substantially all the economic benefits. He's the only
Also
one.
has control.
Sorry?
I said BDO also has a control over the bus.
Exactly. And control is indicated by those two things I mentioned. Substantially all the economic benefits. Yeah, he must have all that, and he must be able to direct the use of the assets. It is those two that represent control, and they must both exist. Both, if he obtains benefit and he doesn't direct the use, like those two scenarios I gave you, those two drivers in those two scenarios, they obtain all the benefit. They are the only one using it, but they don't direct the use. They don't make decision as to the pricing, the route, and all of that. For that reason, we say it's not a lease. So this one, BDO has the two. So he has control over those 5 buses. So there is a lease in this contract, because this question says determine whether they are both contracts is a lease contract. So this is a very direct question. This is a very direct question. Now, this one is similar to that, but I want you to look at it. You will see that this one happens not to be a lease because they said CML. They says CML can use any of that 45. This is where we know that it's not a lease, because they said the lessor can use it also. Automatically, that renders it not a lease, because it must only be the lessee that is using it. The lessor cannot say he wants to use it too. This one is another simple one you can look at. So let's look at this much more difficult one. This one is not so direct. So this one says, under a 4-year agreement, a car wholesaler buy its seat from a manufacturer. Okay, I think that sentence is very straightforward. So a car seat wholesaler car seat, buy its seat from a manufacturer. This one is the normal buying and selling arrangement. He now said that under the terms of the agreement, car seat licenses its know-how to manufacture royalty-free, to allow it to construct a machine capable of manufacturing the car seat to car seat specification. Who can explain this sentence to us? Under the terms of the agreement, car seat licenses its know-how to manufacture royalty-free, to allow it to construct a machine capable of manufacturing the car seat to car seat specification. Who can interpret this sentence?
Hello, sir.
Yes, Latif, go ahead, please.
The car seat is the wholesaler, where the manufacturer is the manufacturer. So the car seat now has a technical know that he gave to manufacturer, who is the manufacturer. Royalty free, that is without any consideration, so that the manufacturer can manufacture the car seat, construct a machine that is capable of manufacturing the car seat to the car seat specification. Well, I think it is a statement that shows that the wholesaler also gives some professional touch or professional capability to the manufacturer, so that what the goods that the wholesaler buys from the manufacturer can be produced to the specification of the wholesaler. I think that's my opinion, sir.
Okay, good, Kyle. So, in addition to what you have said, apparently, this wholesaler, this car seat, he doesn't like the way manufactures those car seats. You know that this guy, this car seat guy, he normally buys seats from manufacturer. So apparently, he's not satisfied with those seats. So I think he knows how to manufacture a machine that will be capable of manufacturing those
The car
seats.
seat.
Yes, in the way he likes it, in his own specification. So, and that's what they are telling us here, that car seats gave a know-how to manufacture, and it's free. So he gave him for free. So that manufacturer can manufacture a machine, can construct a machine that will then be able to manufacture those car seats the way he wants it to his specification. So what's the implication of all of this? Nothing. This know-how has no impact here because it's given for free. It's given for free. So there's nothing. The only thing from here is that now there will now be a machine. Will now manufacture. There's now a machine now. That's the only thing that I'm seeing here. Okay, but that's what this statement is saying. And also they said that ownership of the know-how remains with car seat and the machine has an economic life of 4 years. So the know-how is car seat that it still is know-how. So it keeps it. So the know-how is not anything here. It has no financial impact here. But ultimately now, manufacturer has invested because he has invested in that machine. Now the machine has a life of 4 years. So the key, what is coming out from this paragraph is that manufacturers now gone all the way to manufacture a machine that would then be able to manufacture those seats in the way car seat wants it. And don't forget, even though it was car seat that gave the know-how on how to manufacture that machine to manufacture, the person that invested in developing or constructing that machine is Manufac. So Manufac is the owner of that machine, not car seat. Manufac is the owner. Okay, let's go to the next paragraph. Since car seat pays an amount, so car seat pays an amount per car seats produced by Manufac. Okay, so usually, of course, when he buys those seats, he will pay an amount. However, the agreement states that a minimum payment will be guaranteed each year to allow Manufac to recover the cost of his investment in the machinery. You see, this one they are talking about here is like a lease rental, because they say that the agreement says that a minimum payment will be guaranteed each year to allow Manufac recover the cost of his investment in the machinery. So this goes to show that every year, car seat must pay certain amount of money to Manufac so that you can recover the cost of the machine. So here now he's saying that if Manufac was selling those seats to car seat before, if he was selling it to him 5 naira, now it would be like 2 naira. And it will say 2 naira, it will be like 7 naira. He will sell it to car seats at an higher price. And the normal price is 5 naira. But the fact that this guy has gone all the way to manufacture a machine just to satisfy this guy, this is saying that a minimum payment will be guaranteed each year. So whether car seat buys it or not, he will still pay that minimum payment. He will still pay it. So that's that. They now say the agreement states that the machinery cannot be used to make seats for other customers of Manufac, and that car seat can purchase the machinery at any time. So this paragraph is showing that this machinery now, Manufac cannot use it for any of its customers. It cannot use it for any of its customers except for cassettes. So this question is asking, is there a lease in this arrangement?
No.
Okay, good. Why? Can you tell us more?
The last sentence spoiled all the information from the beginning. The statement pronounced that Manufac do not have control of that asset. So control, as you have said, what do I mean? It does not direct the use of the asset. It cannot use to manufacture it for any other company. So it doesn't have control of it. So that's my own opinion.
Who doesn't have control?
The Manufac.
Hold on. Who is the lessee here? Who is the lessor here?
Based on this, the machinery cannot be used to make seat for other customers of Manufac, and that car seat can purchase the machinery. Okay. The lessee, yes, sir, is the car seat, while the lessor is the Manufac.
Okay. So is there a lease in this agreement?
There is.
Good. So there is a lease in this agreement. And the reason why there is a lease in this arrangement, the underlying asset is the machinery. Manufac owns the machine, and car seat is like leasing it. And car seat has the right to control because he's the only one that is using it. I mean, this last sentence says that the machinery cannot be used to make seat for any other customers except for car seat. So it's really car seat that is using the asset. And it's car seat that is even directing the use is the one that has even originated how the asset will be manufactured, how we can be produced, how we can produce it. So is directing the use of the asset. So it has right to control. So there is a lease in this contract. Just that this particular contract now, there is also a normal purchase agreement. There is a non-lease component, which is car seats buying seats from manufacturer normally. Car seat buying seat for manufacturer normally. So that goes to show that this is really talking about where lease is just part of the contract. Okay. So lease term. So lease term, like I mentioned, is the period over which we're going to use the assets or we're going to lease the assets. And it's usually not a non-cancelable period, which means that we cannot cancel it. We don't expect it to be cancelled. And if it's cancelled, it is not something we expect to happen. So this time is a non-cancelable period. And can this period be extended? Yes, it can be extended. So lease term can include period covered by an option to extend the lease. Only if the lessee is reasonably certain to exercise that option. So lease term can also include period of extension if the lessee is reasonably certain to extend. So how can we be sure that the lessee will extend? So the only way we can be sure is if it is favorable for the lessee to extend. Then the lease term will cover the period of extension. So when it is favorable for the lessee to extend, then we can conveniently say that it is reasonable for him to that we are reasonably certain that the lessee will extend. So what I'm saying is this. So let's say we have a lease contract of 5 years here, okay? And we are paying 10,000 naira per annum. So the lease contract contains a clause which allows the lessee to extend for a further 3 years. Okay. So this agreement says, okay, you can extend for another 3 years. So, and you are going to be paying only 5 naira. Is what I'm saying. So from here now, we can say that we are reasonably certain that the lessee will extend. Because in the original period, he was paying 10,000 per annum. Now you only pay 5 naira. So it's favorable. So therefore, right from the inception of the lease, we won't say the lease is 5 years, but rather we'll say it's 3 years. We'll say it's a 3 years lease. We won't say it's 5 years. We'll say it's 3 years. That's what I'm talking about. And also, I mean, in case of 2, yes, it's a non-cancelable period, but this is not likely where we are certain that, I mean, if you are reasonably certain that it will not exercise, fine, we will not consider the period of termination. It would override that period. Like, for example, the lessee can terminate within 3 years, and the lease term itself is 5 years. But if you are certain that you will not exercise, then the original lease term becomes the lease term. It's still the lease term. I mean, so it's also possible for that to happen. But the common one you would always find is where they will give you an option to extend. Just look out for, is it favorable or not? If it is favorable, then this time will be the extended period. Okay. Now, let's go to how to account for leases. So I want to use this. I want us to go through it together. There's a way I want us to look at this together today. So let's look at accounting for lease. right? I will start with lessee accounting. Okay, so explanation for this one, because something very easy, and I really want you to understand it deep down. So let's say you want to rent a bus and we are asked to pay 10,000 naira per annum for 3 years. Okay, let's keep it like that. You want to rent a bus, so they say you should pay 10,000 naira per annum for 3 years. So now you are the accountant of that company that wants to rent the bus. You are the accountant of the lessee. So in year one, what will be the entry you will pass in year one for this transaction? Assuming that they will allow you pick up the bus, then you start paying rent at the end of each year. Use this 10,000 you paid at the end of each year. So let's hear from you. Let me hear from Prudence. Is Prudence in this class?
Yes, Mr. Wasiu. Good evening.
Okay, all right. Prudence. So let's have it.
Sorry, what did you say?
Okay, well, thank God I called you. You were not even listening to anything we're saying. What entry are you going to pass in year one if your company rents a bus and they are paying 10,000 naira per annum? They're supposed to pay for 3 years. So in year one, what entry are you going to pass?
Okay, so you mean to debit the right of use?
Okay, you said
And
you debit what?
you debit right of use and you credit lease liability.
Debit right of use, credit lease liability. Wow. How did you know all of this? Make sure you're supposed to be in this class. You should not be in profession.
Ah,
Okay. Well, I think you need to explain further because I'm not sure I've taught you anything like this before, but you know it anyway. What do you mean by right of use?
okay, so there's a transfer of the asset from the lessor to the lessee. Automatically, the lessee has that obligation to be responding on yearly basis the amount that is agreed on as per the agreed contract. So the right of use is sorry, I'm just trying to please take it up from there. I know that you need to debit the right of use. That's the access now that belongs to, for that period, belongs to the lessee. So there's an account that will be
Okay, our network is gone. I was going to pick some of our knowledge. Let me see why she said we should. So Latif, do you agree with this entry?
I think he's correct, sir, because you debit the asset really, and you credit liability. Lease payable rather, whatever.
Okay, no problem. She's actually correct, but unfortunately, she doesn't know why, and neither Latif knows why we are debiting right of use, and also we are crediting lease. What I would have expected to hear was probably maybe in year one, would debit rent to P&L and probably credit payable, since we have not paid it, since they say we should pay at the end of the year. That's what I would have expected primarily from you. But I mean, you would actually know the right thing, but you don't know why we are debiting right of use and crediting this liability. So I need you to listen attentively. Unfortunately, our network has thrown her out. Hopefully she'll be able to listen to the video later. Okay, so let me start from lease liability. Why are we crediting lease liability? See, the reason why we are crediting lease liability is because right from the inception of the lease, right from the agreement, the lessee has an obligation to pay 10,000 naira, not for 1 year, but for 3 years. He has an obligation for 3 years. And for that reason, we need to credit not just any payable, but a lease liability. Because it meets the definition of a liability, a present obligation to transfer economic resource as a result of past event. And a present obligation is a duty in which an entity has no practical ability to avoid. So that obligation exists right from the commencement of the lease. It exists, it's there. That's why we have to credit lease liability. And we are debiting right of use assets because for 3 years, the lessee would have right to control the assets. In fact, this right of use asset is as good as debiting the asset. Just that IFRS 16 says that we should call that asset right of use assets. Some people used to call it lease assets, but IFRS 16 says let's call it right of use assets. So now we are putting this as assets in the books of the lessee because for 3 years, for the lease term, the lessee has right to control. He has right to control the assets. And anyone that has right to control an asset should recognize that asset in its books. If you remember substance over form, anyone that has right to control an asset must put that asset in his books. And if you remember the definition of assets in the conceptual framework, it says an asset is a present economic resource controlled by an entity as a result of past events. In this case, the lessee has control over the asset for 3 years because he's the one that will be obtaining all the economic benefits and he will be directing the use. And that's why we have to debit rights of use assets. Then, to that debit and credits. Then another one is how much are we going to use debits this account right of use and how much are we going to credit? So what do you think? Ahmed, what do you think? How much in year one? So Latif, can you try please?
But there's something confusing here is that there is no any interest that is attributable to the question you have. Like you have said, it's 10,000. But ordinarily, if it were to be a standard question, the interest will be added and it will not be 10,000 again at the end.
I don't understand. Like, what interest are you looking at?
He's talking about the rate.
Okay, you want a rate? I'll give you a rate. So you have your rates.
Mr. Ahmed, go ahead. Go ahead.
You see, logically, one can say that it's 30,000. That is 30,000. In fact, some people would think it's 10,000. But that would be wrong. If you say you're recognizing 10,000 in your work, that would be very wrong. And the reason it's wrong is that your obligation as of year one is not 10,000. Your obligation is the whole amount you pay over the lease term, in as much as you have not paid anyone. So it should be 30K. So assuming that you have paid 10,000 at the commencement, let's say the guy said you have to drop 10K. So that means your obligation is remaining 20K over the period. Your obligation is now 20K, but now you didn't do any deposits. So his obligation over the period is 30K. So you will see that here, because of that contract that exists, his obligation is not just year one obligation. He owes that 30K. You have entered a contract. They give you an asset. They give you an asset. And you have agreed you pay 10,000 over 3 years. That means right from day one, you owe that 30K. Just that you're not paying it like immediately. You're paying it over 3 years. And this should make sense. This is just similar to buying an asset on credit. And they are saying pay over 3 years. So you will not say is only the year one amount that you owe. You owe all the money for the assets. You owe all the money for the assets. And that's the ideology here. Now, see, where the technicality lies here is this. We cannot recognize this amount at 30,000. We cannot recognize this amount at 30,000 because 30K is a future value. 30,000 is what we're going to pay at the end of year one, at the end of year two, at the end of year three.
I'm sorry, sir. I ran out of data, so I've been trying to log in. I'm back. Sorry.
Yeah, you're welcome back. So sorry. Just continue to pay attention. So,
Sir, it looked like many of our colleagues they didn't join this class. We are only 5 on this call.
yes, I noted. I don't know why some people joined and left. I don't know. We were up to 8.
Well, if you check your WhatsApp group, sir, some are complaining that they've been trying to log in.
His
Prudence is
network.
I think
No, it's only Prudence. So
she's the one that just put a message and she's back now.
she's back. I'm
Okay,
not sure
no
it's a
worries.
general
Let's
thing.
continue.
Yes, we have to see. The thing is that I'm used to this. A lot of people give up easily, and a lot of people with their personal reasons. So even if it is one person that is here, I would teach. So we can never use other people. You cannot use other people to judge your own actions and inactions.
I see. Well,
Yeah. So, and that's where you really have to be. You that you have made effort to be here. I mean, we need to move on and ensure you get value. Those that did not join, they did not join for their personal reasons. So class has to go on. Okay. So, like I was saying, The 30,000 cannot fly because it's a future value. It's a future value. And in reporting, we don't recognize future. We don't recognize future value. What we recognize in our books is the present value. So instead of this 30K, it will not fly. Let's cross it out. 30K will not work. So we need to get the present value of this 30K. We need to get the present value. So how do we get the present value of this 30,000? If you do this, if you do PV equal to future value into bracket 1 plus R raised to power minus N, you'll be wrong. You'll be wrong. You cannot use to get the present value. What you need to get the present value is this PV equal to annuity to bracket 1 minus 1 plus R raised to power minus N divided by R. Is this you have to use to do it, not this. And the reason is that this one is the right one because we are dealing with annual equal amounts. When you have annual equal amounts, it's better to use this formula to get your present value. You can use this too, but it's not advisable, right? Especially when you have longer years, because you have to do it year after year, year after year. This one is suitable. This other one is suitable where you just need to get present value of just a single future value. So let's say they said you want to pay 100,000 in the next 20 years, 100K in 20 years. You are now asked to get the present value of that 100,000. And that one is straightforward. This N will just become 20. Or they say you want to pay 50,000 in 5 years' time. What's the present value of that 50,000 today? This one is still this one. So this N will just be 5. But when it comes to present value of equal annual payments, like when you have multiple equal payments for several years, and you want to get the present value of all those payments, you use annuity. And that's the scenario here. So if you punch your calculator with this, it should be giving you around 24,000 something.
Okay.
24,000 something. This is 24,750. I'm not sure. So this is what the present. So what you put in your books is the present value of those payments. And you are going to use that to credit your lease liability and use that to debit your right of use assets. And that is what you do at commencement. And that's all. So I really need you to understand this. I'm not just following the material today because I want you to understand, when you look at the material, to understand, okay, why we are saying liability are measured at the present value of the unpaid lease rentals, at the present value of the unpaid lease rental. This is what we are saying. You need to understand it. That right from day one, you have liability for the entire amount. And what you put in your books is the present value because those amounts are future payments. So what you put in your books are the present value. So you credit liability with that present value and you debit right of use assets with that present value. Is this clear?
Yes, sir.
Is this clear?
Not too clear, sir.
Which area?
First and foremost, I want to ask, what of a situation whereby there is a kind of when the person drop some amount initially
Okay.
and expect to pay the remaining balance maybe in the next 3 years or two.
So it means that when you are getting the annuity, let's say for example now, from this example I gave you, the guy paid
Yes.
10,000 naira immediately and he will
Okay.
pay the remaining 20,000 over 2
Okay.
years. So when
Okay.
you are getting the present value, this N, instead of 3, it will be 2.
Turn to 2. Okay. So we are not
Yes.
going to consider the 10,000 initially paid as part of the
Yes.
annuity.
Like, yes, because
Okay.
we are not owing that anymore.
Okay. Okay.
Any other questions?
Yes. Please, there are some leads that um, is being paid from the beginning. Like you want to use an asset for 5 years, let's say 5 million, and you sign a contract, you pay that 5 million the initial start. So how do we treat that?
And that one becomes so easy. That one is so easy. You just need to debit right of use asset and credit bank.
So is there no need for present?
Liability.
No.
There's no need for present value again. Yeah, it's paid it right from day one.
Okay.
Yes. And that is not even the spirit of lease. That's not what IFRS system doesn't really appreciate that. Because all of these things I'm teaching you doesn't really apply to that. Because that one is so straightforward. So why, instead of do that, why don't you just go and buy your own property if you have money? The point of leases is for those that don't have money. It's not for you that have money. You have money. Why are you paying for 5 years?
The reason why I'm saying this is that let's take for instance land.
Mhm.
You might want to use a space for a business. Let's assume that land is worth more than that value that you're paying for. But because you want to use it, let's say for 10 years, and you have to go into this kind of agreement.
I know. Why don't you just pay per annum now and use that money to be doing something else? When you're not a bank, it's bank that have free money, customer deposit that they can be using to be doing anyhow. You that you're hustling for money, you're not going to drop 5 years, 10 years rent. Good day.
Mm, at times, it is based on maybe location or trying to build a business for a longer period, and you don't want to have a situation where within those periods you want to build that thing, you will have to move. Why? But let's continue.
Yeah, you're right. So those scenarios are very straightforward. Very, I mean, because you just debit right of use, credit bank. So when I get to what you do with the right of use, that's the only thing you will do. So the issue of present valuing, because you have paid all the money now, so there's no issue of future payments anymore. Okay. So I mean, if you find that one in your exam, the examiner just wants to gift you mark. And I agree with Lukman. Most of, especially on Allen, for example, now in Lagos, they will ask you to pay 3 years minimum. Sometimes some people do 10 years lease and they will pay. That's because I mean it really happens very well.
You guys now, they used to do that so that they can secure the location.
Exactly. Exactly. So I know, yeah. But I mean the issue here, I mean, if you remember the way I started the whole thing, the whole idea here is that to give opportunity for those that don't have that money so that they can be paying small. That's the main thrust of this standard. People paying little by little like that. And how do we account for that is what is more relevant here. Okay, so that's at the commencement date. I want to believe that we understand this one very well now. Now let's go to at the end of the year. Let's go to the end of the year. So what happened at the end of the year is that the lessee will pay the rent. At the end of the year, he will pay rent. And when he pays rent, who can tell me what entry are we going to pass? Yami, what do you think?
We have to reduce the lease liability.
So does that mean we are going to credit it or debit it?
We'll debit.
That's correct. We'll debit the lease liability. What do we credit?
Interest will be down.
Sorry? What do we credit? Bank now, should be we are paying. So with how much now? With how much every year? Who is talking? Is it Latif that is talking or? That should be with 10,000 naira, which is the annual rent. So with 10,000 naira every year. Okay. So if you do this in year 1, in year 2, in year 3, there's a problem here. There's a problem that will happen in year 3. Is anybody seeing it? There's an issue we'll have at the end of year 3. If you are paying 10K, 10,000 in year 1, 10,000 in year 2, 10,000 in year 3, there's a potential problem that will happen. And the problem is
Overpaid.
exactly because our liability that we said that was in our book was 24,000, but we are paying 10K. So how do we correct that? So we need to start unwinding the discounts. Unwinding the discounts. So anytime you do present value, anytime you present values on future payments, as you move through time, you need to unwind that discount. You need to unwind it just so that as you then get to that future, this 24,000 will have become 30,000. Because unwinding the discount will help you return back those interests. Because present value is like accounting for time value of money. We are saying 30,000 in the future, the value of that today is 24,000. So as you move through time, you need to start releasing back those discounts. You need to start releasing back those inflationary factors, right? And we do that through finance costs, or interests, finance costs. So the way it's calculated is the discount rates, you apply it on the opening balance. You apply it on the opening liability, that will give you 2,470. So this interest, you simply debit P or L with it, and you're going to be releasing it to the lease liability so that will return it back to 30K. And that is what will correct this one, this rent we are paying every year. So by the time we are paying year 3, it will balance up. The balance in that account will be exactly 10,000 so that it can net off. So everything will just net off. So this is how it actually works. Now, you see, all of this double debit credit thing I'm actually teaching you is just to really build you squarely. You see, in exam, the examiner doesn't really ask you so much about this debit and credit thing in such a way that in exam, all you just need to know, let me summarize all these debit and credits from year one down to this place. All you will do when you start solving questions is that we'll start with balance carried forward for year one. Let's say that 24,750. We'll add that finance cost at that 10%, which is that 24,750. 2475. Then you deduct lease rentals, which is 10,000. So whatever you have as balance here, call this balance carry forward. See, whatever you have as balance here, that's what will go in as your liability. While this finance costs is what will go into P&L. That is what the examiner cares about. Justice. But I feel that it's just important you know all of this sequencing, because that makes you a complete accountant. But in the exam, from all the questions I'll be solving, this is what we'll do. This is what we'll do.
Hello,
That is
sir.
all the lease liability. Yes,
Hello.
Latifi.
You added that 24,750 to 24,755, Abi.
Yes.
It shouldn't be 10,000.
Which one? No, this one is different. This one is the lease rentals. So then I deducted lease rentals. These lease rentals, yeah. They are
What
the
he's saying
rental.
is that you didn't put the total before you remove the 10,000. So that's what he's saying.
You don't have to put it. We don't need that total. We don't need that total. You don't have to put it.
Then what do we carry forward then?
The balance now, 2475 plus 24,750 plus the finance cost minus the lease rentals.
That's what I
Whatever you
did, sir.
get, that's what you're carrying. That's your liability. That's what you carry forward. Is that clear?
Yes, sir. Yes.
So that is all for the liability side. You see, for this right of use asset side, because it's simply an asset, it's similar to PPE or whatever assets class that this asset belongs. So all you do with this 24,750 that you must have recognized is just for you to depreciate it. You just calculate depreciation per annum. So this should just be 24,750 divided by what? Is it over the lease term or over the useful life?
Over the useful life.
It's over the lease term.
Over the
Don't,
list.
yes, please don't for this one is very important. That's because that's the main thing for right of use. You depreciate it over the lease term. Because that's the period over which you have control. Lease term. Some people say the lower of the lease term and the useful life. But I wonder why they say that. Because why would you go and lease an asset for a period higher than its useful life? You know that the useful life is 5 years. You now went to I sign a lease for 7 years. How would you do that? So reasonably, the lease term will be the lower. So we depreciate the right of use assets over the lease term. Do you know that, like, I think it was Jamie that mentioned it, if we had paid 10,000 at commencement dates, the PV we will have computed here will have been on the basis of 2 years, because what we'll be owing is just 20,000. So if you do the PV, it would be like 14,000 something or something like that. Is that 14,000 we will debit and we'll credit. We'll debit to right of use, we also credit to. You know that when you get to this right of use, that 14,000, you have to come and add the amount paid at the commencement date. In fact, the way you get the cost of right of use is the PV of unpaid lease rentals plus amount paid at commencement date. That's for right of use. And the reason is that for the asset, we believe that the value of the asset is the amount you are paying over the period. Is the amount you are paying over the period. The lease liability is how much you are owing over the period. So whenever you have a scenario whereby what you are owing is now lower, or where you have paid some amount at the commencement date. So right of use, we have an issue with that. It's okay just for this debit and credit to be complete with the same amount. But by the time you want to really determine the cost of the right of use, any amount paid at commencement date must be factored in. So that means that the amount you are paying at the commencement date as a lessee, you're going to credit bank. What you're debiting is this right of use asset. Is that clear? Maybe when we solve questions, it'll be clearer. You will see. Then it is the addition of these two that you will depreciate over the lease term. That is everything for lessee accounting. That is all for lessee accounting. Do we have any questions?
Yes, sir.
Okay.
Depreciation is applicable to cost of assets.
Yes.
So do now that initial deposit plus the PV of the unpaid represent the addition of the two represent the cost, which is right of use.
Let's say it again. I didn't get you.
Depreciation is applicable to cost of the asset. So do we now agree here that the cost of the asset, which is right of use asset, the cost is the addition of the unpaid and the initial deposit paid?
Exactly. That's what it says.
Okay, sir.
I have a question.
Okay.
So, assuming the lease payment did not start as in at the beginning of the year, maybe towards or maybe at the end of the year, how do you calculate or account for it?
That's what I've just explained.
Oh, I understand.
That's everything we have done here now.
Okay.
Hello, sir.
Yes, that's okay.
That table you just gave, that balance brought forward, add
This
the
one.
finance less the annual payment. Is that what you refer to as a lease amortization schedule?
You want to call it that, no problem, but that is not what it's called. We don't have a name for it. It's just a table.
It's
Okay,
just
sir.
a table to calculate present value of the lease payment.
Just to get the balance of the liability.
Okay,
It's
sir.
just a schedule. It's just a schedule. But as accountants, you need to understand this debit and credit. This is the most important for you. This one is nothing. If you understand this from the beginning, because this is what you will do in reality. This is what you pass into your GLs, right? This one is nothing. This one is just, this lease liability is the entry you have passed here for the liability. This finance cost is the entry you have passed here for the unwinding of discount, which is this credit to lease liability, which is why you are adding it here, because you credited the lease liability. The lease rentals, which is the rent you paid, and you debited the lease liability here, which is why you are removing it. So this schedule is just what you have done in your books already. You just want to make it a little easy for you. So ordinarily, it might not be necessary because your liability account would already show this balance. Your liability GL should show this balance already. Right? So this one might just make sense because with this, I can project, I can do for the 3 years. And I would be able to do some simulations and all. Since the amounts are constant, the payments are constant every year. So I can just do, okay, this balance carry forward. Okay, no, this is not balance carry forward. This balance go forward, yeah. Then I can carry that one to next year and like that. What sort of questions you see anyways? Okay. At least those questions shows that to a large extent you understand it very well. Now, for the lessor, see, the lessor is the owner of these assets. The lessor is the owner of these assets. So we would expect that the assets should be sit the lessor. We would expect to find it in his books. So the major accounting issue here is that should we still continue to have it in the books of the lessor? Should he leave it in his books? Or should he derecognize it from its books? That's the major accounting issue that we need to answer. As soon as we can establish that, that is it. That's all the lessor wants to do. Should he just leave the asset in his books or should he remove it, considering the fact that he has leased it out? So the answer to that depends on the classification of lease. The answer to that depends on the classification of lease the lessor has entered into. So now, for the lessor, he needs to identify whether he has entered into a finance lease or an operating lease. You see, this classification of lease does not apply to the lessee. It has nothing to do with the lessee. All the lessee does is just right of use and lease liability. Then it does these payments and all of that. That's lessee. But for lessor, his major issue is should he derecognize the assets or should he leave the assets in its books? That is major issue. So for him to know what to do, he needs to identify what class of lease he has entered into. Is it finance lease? Is it an operating lease? Let me see the people in class now. Let me see. Okay. Prudence, do you know the difference between these two? Finance and operating lease.
By my understanding, just in a layman's understanding, let me put it that way. Finance is when the lessee takes full responsibility of the assets, maintenance, Yeah, but operating, no, sir. I think that's all I know.
Good attempt. But no, that's not it. So
Can I
what?
try?
Yes, please, Oliver.
Okay, good evening.
Good evening.
I think for finance lease, it's a kind of lease that at the end of the leasing period, the asset is transferred to the lessee. But for operating lease, the assets still remain in so let me put it this way. The finance lease, the assets at the end of the lease would automatically belong to that of the lessee. But for operating lease, the asset still remains the property of the lessor.
Good idea. But you'll have gotten 1/5.
One of
Because you already mentioned one of it. So
okay, one of it.
that's also a good idea, right? So the starting point is this. Is a finance lease where there is a transfer of risk and reward. That's a finance lease. Where there is a transfer of risk and reward attributable to. So the key word is transfer of risk and reward. So you see, the opposite of what I just said is operating lease, where there is no transfer of risk and reward. That's operating lease. So from my explanation now, if the lessor is able to identify that he has entered into a finance lease, then he will really have to derecognize the asset. But if it is an operating lease, actually, in fact, he will not. We'll get to that fully later, sure. But I mean, this brief explanation doesn't really further help us in identifying a finance lease, because when you say when there is a transfer of risk and reward, what do you mean by transfer of risk and reward? That okay, they have transfer of risk and reward. What's that? What shows that they have transferred risk and reward? 5 things, right? Number one, where there would be, or is a future thing, where there would be transfer of ownership of the assets, to the lessee, ownership of the assets to the lessee at the end of the lease term. So where there will be transfer of ownership of the assets to the lessee at the end of the lease term is one indicator that there's a transfer of risk and reward, but that is not the only indicator, and only this one cannot be pointed out. Number two is where the lease term is almost equal to the useful life of the assets, where the lease term and the useful life are almost equal, is also an indicator. Another one is where the PV of lease rentals is almost equal to the fair value of the assets. That's also an indicator too, that there is a transfer of risk and reward. Another one is where there is a purchase option. That's also an indicator too. And when we say purchase option, we are talking about like an option given to the lessee to buy the assets at scrap. That's a purchase option. So you find out that purchase options are always very small. It's very low. So where the lessor gives the lessee a purchase option, then is most likely that the lessee will take that option because the price will be very low compared to what he can get outside for a similar asset. Because the purchase option is always a very low offer. That come and buy this asset off at a very small amount. So it's also an indicator that there has been a transfer of risk and reward. And finally is that if the underlying asset is of specialized nature, that only the lessee can use it, and use the assets without significant modification. That's also an indicator that we are looking at a finance lease here. So you see, these 5 indicators, you must know it because they can ask it. And for my FR student, I don't want you to joke with things like this because they usually give it out for 5 marks. I mean, those are the areas where you can get cheap marks. Just know these 5. They will ask you, what are the indicators of a finance lease? Just tell them that 5 and move forward. Okay, that's it.
Thank you so much, sir. Sir, is it all these factors that must, or just some specific ones?
Everything.
Wow, wow.
Now, how do you then account for finance lease? How do you then account for finance lease? I've already mentioned it. That means if the lessor identifies that is a finance lease, that means the first thing he will do is to recognize the asset. So, and Lukman, if he's recognizing the assets, is he going to debit the asset or credit it?
Credit.
That's good. Thank you. So that means this one means that he will credit the assets. Then what will he debit? What will he then debit? Who can guess? Prudence, can you guess? What will he debit?
Oh, okay, so
Lease.
either or the lease liability.
This liability in Koko.
Presents the asset after it's bank.
Thank you. He would debit a lease receivable.
Release what?
Lease
Receive-
receivable.
The receivable.
Lease receivable. And another name for it, there's another name for it. They call it net investment in the lease. Can also call it net investment in the lease. This is what you would debit. That's what this lessor would do majorly. That's the first thing he would do. But how will he compute this lease receivable? How will he compute it? This lease receivable or net investment in the lease? Latif, can you guess? How do you think he will compute this lease receivable? It's actually easy. If you remember how the lessee computed his lease liability, it's the same thing here too. Because to lessee, he has liability. To lessor, he has receivable. So it's like a mirror image. So it's like the PV of unpaid lease rentals. This lease receivable is just, you see, all the rents that is expecting from the lessee in the future, you will discount everything to present value. That's what you put in as net investment in the lease or lease receivable. And it makes sense. Everything is expecting from the lease arrangement, present value of the unpaid lease rentals. But in addition to rents, right? Because he's the owner of these assets, this guy is also will be expecting the residual value, should in case. In fact, he always wants to also get residual value. He wants to get everything. So this is where the issue always arises. This residual value part. Because the lessee wants to, because the lessee knows that this is a finance lease and is most likely not returning the asset because the lease term is almost equal to the useful life. So the lessee knows that. So they will have agreed on what the residual value of these assets will be. I mean, when I say residual value, I mean the scrap value or the remaining value of the asset at the end of its useful life. The lessor will usually want to collect it right from day one. That, okay, you are the one that is using all these assets. So in addition to this rent you are paying, I need us to agree on what the residual value would be. So usually they would agree. And the lessee will be forced to pay it. So let's say they agreed 50K. So they will do it in such a way that they will not wait until the end of the lease term before the lessee pays it because they know he might not pay. So what they will have done, factored that amount inside the rent that the lessee will pay. It will already be there. The lessee would be paying it over the lease term. In fact, IFRS 16 calls that guaranteed residual value. Guaranteed. So that guaranteed residual value, we expect it to be inside here because they have agreed it. The lessee has agreed to it. So instead of paying it at the end of the lease term, just start paying it gradually now. So we assume that guaranteed residual value is included in these lease rentals. However, in some cases, the lessor will usually expect much more than what the lessee has offered as residual value. I mean, if the lessee offers, let's say, 50,000 as residual value, which is guaranteed, because it means that the lessee would pay that. Usually, the lessor will say no, that just 5 years. I feel that this asset should be able to do 100,000 residual. The lessee will say, me, I cannot do 100,000. No, I cannot. But I'm guaranteeing you 50K. So if that time comes and we're able to sell the asset for 100K, I will hand over your 50,000 extra to you. That's if it happens like that way. So how do we account for that? Because the lessor is also expecting that. That means in cases where that occurs, where the lessor believes he can get much more than what the lessor has guaranteed. So we'll have a scenario of unguaranteed residual value. The guy will put it in his books right from day one that I am also expecting this one too. It will be in his books that he's expecting it. But since it's a future amount, to be the present value, of the unguaranteed residual value. And the addition of these two is how we calculate the receivable or the net investments in this. The addition of the two. So this is how we compute lease receivable or net investment in the lease. PV of unpaid lease rentals plus PV of unguaranteed residual value. Any question? Any question? Okay. That means you all understand it. Now,
No, but we understand more when we have samples.
okay, no problem then. So at the end of the year, the lessor will receive rent. The lessor will receive rent at the end of the year. So this rent he receives, he will simply debit bank, and credit the lease receivable. Also, because we present value those rents at the beginning, just like we did for lessee, we need to unwind the discount. We need to unwind the discount through finance costs as well. So the examiner will give you that finance cost. So we simply debit finance costs, and in this case, it would be a finance income because we're dealing with assets. And since it's an income, credit it and we debit lease receivable or net investment in the lease. Either one. Again, just like I told you for lease liability, this one also, the debit and credit thing might not really be a thing, in the sense that in the exam, you just need to do just a simple schedule where we'll have balance brought forward, which is whatever the addition of these two. Then the finance income will be added. Then the thoughts, the lease rentals. The addition of these three will give you the balance carried forward to next year like that. See, I've just summarized this whole thing with this schedule. So this balance brought forward is what you will have completed here. The finance income, debiting lease receivable means adding finance income to it. And the same way you compute finance cost is exactly how you compute finance income here too. Crediting lease receivable with the rent is like removing it or deducting that rent from lease receivable. Then you get your balance at the end of that here. And that is everything for finance lease. That's everything for finance lease. For operating lease, it's quite straightforward because you are not touching your asset is still there. So the only thing the lessor does is to recognize the rent received or receivable in profit or loss. I mean, it's just like debiting bank and crediting rentals income. But the technicality there is that this rent received is credited to P&L on a straight line basis. on a straight line basis. And when we say on a straight line basis, we mean equal amount of rent must be recognized every year. Equal. So you have to make it equal. So even if the rent is not paid, it's not the same rent every year, you must find a way to recognize equal amount every year. Equal amount must be recognized every year. So I'm going to stop here for tonight. I've explained all the principles. All the principles. So what we're going to be doing next week is just solve questions. Then we're going to round up with leases. Immediately after lease, I'm starting ratio. Immediately after ratio, I'm starting published and past corrections. We'll start reviewing past corrections. So the whole of April is going to be for past corrections. While our Thursday class, we are not going to miss it again. I have IAS 8, IFRS 5, IAS 20. Those are key. They are very straightforward standards. But those are the 3 primary standards I quickly want to teach you guys. And as soon as we're able to take that one off, you guys are just ready, fully ready for this exam. So, I mean, how I wish out of my plenty students I have on the group, those that looks as if they are busy is, I don't know, it's very unfortunate. They can't attend the classes. So I wish you can speak to them that the exam is just, our classes, we just have 4 normal classes to go. Even though by implication of that Thursday class, it means that we have like 8 meetings. We still meet like 8 times, so which is major. It's still a long journey for us as it is right now. But I'm going to stop here for today anyways. I'll meet you guys on Thursday for accounting policy. And that will also be like an hour or an hour and a half class. Hopefully it's exciting and you can gain a lot from that. So any questions, please, before we go?
Yes, sir. So I would like to confirm the present value of the unguaranteed residual value. Are we using the same formula to arrive at it?
No, this one will be the form, because this one is just one payment in the future. You'll be using this one. Raised to power minus n.
Okay.
The formula you use for this. Why this one is an annuity formula? Okay, yeah, that's it. You want to ask a question?
Not really a question, but I would love to say this if I'm permitted.
Okay, please,
I,
you are permitted.
I know that Mr. Abe would not be would not be taking only the group account. I know by my own thinking that he should be having up to 3 more, whatever like that. And I don't know his schedule. I know he's busy and is that he has not been able at least to spend much time with us like that. And though his method is so concise and comprehensive, however, if we fail to do everything before this month, I hope we will not be pushing us towards a week to exam or something like that. So I don't know how you come in and be what you can do so that it will not be a rush, whatever till later.
Yeah, I'll monitor his progress. I'll speak with him. I'll see him on this weekend. He will tell me his plans on finishing. I will see to him not missing classes, because missing class and trying to push it to Thursday, I really don't want to encourage that much. But we would ensure it covers. Would cover 100%. That I think is going to happen for FR. Whatever it is that is outstanding, either him or me will teach it and move on. So yeah, that's what's going to happen eventually in April. So we'll just ensure that I think usually have you when? Tuesdays?
Yes, sir. Yes, sir.
Yeah, Tuesdays. So we just ensure that that Tuesday's class is not vacant anymore. Only day is not going to be available. I'll just quickly fill in for him like that.
Okay. Sir. Thank you so
Yeah,
much. Thank you, sir.
you're welcome. Yeah, see you. Bye.
Thank you, sir.
Yeah.